All right, all right. Good evening, everyone. Good evening. Um, I'm excited to have you here. Good evening. Trust our day is running up well. Okay, I can see a number of people. I'm just gonna shout out to you all. I can say hi to Loretta, hi David, hi Mayowa, hi Onyeka, hi Peter, hi Uche. It's good to have you here today. Okay, so before we get right into it, I like to meet everybody. So just say hi in the chat box and drop an emoji, or also tell us where you're joining from. If you're in Lagos, if you're out of Lagos, if you're in Nigeria, even out of Nigeria, let's just know. I'll be in the chat box. Hi from Lekki. Peter's from Lekki. Oh, thank you, Peter, for joining. Hi, Uche. Thank you for joining. Let's get like two more eyes and then we'll kick off. Oh, my was from Shomolu. Nice. And then Loretta from Ikeja. Thank you all for joining in today. Thank you for joining. And if you know a colleague who would benefit from tonight's session, please do not hesitate to invite them. You can still send them the link and they can still join. Let's not keep learning. Please send to them. So my name is Ademide and I'll be your host for today, Ademide Adeboye. And I'm really excited today because of this session. When it comes to finance, people would usually just see like, oh, finance, there's so many jargons. Sometimes I can't even have conversations with them. I don't understand the terminologies and every other things like that. But today, we're going to be demystifying some of those financial basics every professional should know, right? And we're going to have a lovely session. So sit back and enjoy this ride. But before we get into that, I mean, you most likely are coming across Crosstie Solutions for the first time. So let me tell you who we are. We're a people development and management consulting firm, and we've been around since 2013, and we are dedicated to help individuals and professionals and organizations rather. So professionals and organizations were dedicated to have them thrive. So business improvement and business performance is one thing that you always see when you see anything from Crosstie. And then we run, we have several trainings and the people development arm of the business, from leadership to soft skills to customer service and all of that. And in the consulting management part of the business, we have various services like HR, transformation management. We have corporate strategy, and we also have a tool which we call organization health check that helps you to check the state, the health of your organization. So, and then, these are the things that we do in Crosstie. But we also thought about it that it would be nice for us to, give back in our commitment to building personal capability across levels in different organizations. We decided to give to you guys, and we thought about it. How can we do this? And then we came about Crosstie webinar series. So we've been having this series for a while now, and this is the November edition. And today we're talking about finance. So yes, we're talking about finance, basic finance for professionals. We'll cover finance, why finance is the language of business. I don't know if you've ever heard that people say, oh, finance is the language of business, because it is, but we'll get to know why today. And we'll also walk through the essential concept that helps teams and leaders make smarter decisions. So, and then we thought about it, who could be our facilitator, who could teach us these things, who could explain and demystify some of these things. And then it was no other person than Mr. Ajibola, right? And it's going to be leading us into this session. It will break down concepts, like financial statement, cash flow, budgeting, which is most popular, and people still even miss it. You don't even get to know, okay, what's really budgeting? What's it about? Then someone is telling you actual, someone is telling you this, and it's okay. Today, we're going to understand what all of this is about. So without any further ado, let's welcome our facilitator for today's session, Ajibola Jinadu. Thank you so much.
Thank you for having me. I'm not even sure 30 minutes is enough to cover
Yeah, I
everything
know,
that you
right?
that you've said.
I know.
Yeah. So we'll just be covering the basics. And it's really because, like I said, it's so broad, but once you understand the basics, or once people understand the basics, then they can like try to see how it applies to so many other things. And one thing I want to just even say, finance is not the language of business. Accounting is the language of business, but and they're not the same. So that's another thing. Yeah, they're not the same, but it's important to know that. Um, all right, so I think I'll have to share the slides from here. Um, just a second. I'm very prepared for that. Get that started. So good evening to everyone. And I hope you really do get a lot of value from this event. So just checking that you can see my screen. That's it. See the
Yes,
slide
I
being
can see your
presented.
screen.
All right. So I'm just going to, I know you will let me know, but let me also put a timer on so that we don't go beyond. So yeah, welcome everyone. I can even see some very familiar names on the participant list. All right, so today, for about 30 minutes or so, I will just talk about the basics for professionals. So I'm going to assume that a lot of the audience are not really finance professionals. But then it doesn't really matter because by the time we're done with this, you understand that finance is everybody's business. So a bit about me, which is not really relevant, but I spent almost 2 decades in accounting, but I actually started long before I even started working. I always knew I was going to be an accountant from a very young age. But then, so that made me start as early as possible in that space. But eventually, I actually got to the point where I started with accounting, then I realized that finance was something else entirely. So I spent about 10 years at Deloitte, rose to manager level. Then since then, I've actually been a CFO, both full-time and part-time. So a lot of these things I'm going to be sharing with you are actually coming from real life experiences of how I've actually encountered finance and how I actually explain finance to people. Whether you are a newbie or you've been around for a while, this is how I actually explain finance to a lot of people. So everything is coming from my experience. So our start point is pretty much what is finance? We need to actually start from there. What is finance? And ultimately, I mean, there are many definitions you can give it, but because this is the basic class, the most basic way you can explain finance is the management of money. And it's as simple as that. So it's not accounting. You don't have to record anything or learn principles. You just need to know how to manage money. So when you have people running finance, they don't actually even have to be literate. So a market woman on the streets does finance because at the end of the day, people manage money. So everybody on the call, whether you are in the finance department or not, you're actually going to do some level of management of money. So that's what finance is. And it's as simple as that. Once money is involved, then that's what finance is. Nothing too technical, pretty much what it is in that way. So I want to say everybody, but let's say every adult, every functioning adult is involved in finance in one way or the other. So the only difference is in the context of what we're talking about today is we have what we call personal finance and then we have what we call corporate finance. So personal finance deals with human beings or with people, individuals managing their money. And then you have corporate finance where you actually have corporate entities and businesses managing money. But outside the scope of this class, for me, they are literally the same thing. It's just the people that are involved that are there. So companies have assets, humans have assets. Companies have liabilities, human beings have liabilities. Companies make revenue, human beings earn income. all of it is pretty much the same when you strip it down to the basics. So first point here is to understand that finance is simply the management of money. So before we go into how everything ties into all the decision making and all of that, let's focus on corporate finance today, because a lot of people are working professionals. So the start point is what I'm going to call like the background of what we're going to talk about, is that first off is to understand that the primary purpose of business is money, or to make money. Let's put it that way. So every business in the world, everyone that calls itself a business is a business because of money. Money is involved. So in business, there can be no emotion, or once you just say you're running a business, just know that money is going to be involved. So it doesn't even matter whether you are making profits or not, whether you're profit making, whether you're NGO or whatever. But the fact is that money would come in, money would go out. That is finance. So remember, finance is the management of money. And then you now have a business that is set up. And the only, or well, not only, but the primary purpose of that business is to actually do something with money. For many people, they want to actually make profits when they set up a business. So when you hear somebody say, I'm a businessman, they just find something that they're doing to make money. But businesses are there for money purposes, especially when they become registered and they're a corporate entity on their own. Money is involved. So, so when we now take it back to finance, and we say finance is the management of money, what we are really looking at here is what is the goal? And the goal of finance is to ensure that you make more money than you spend. So again, if you take it back to personal finance, it's pretty much the same thing. As a human being, you can literally, what you literally want is for your income to outweigh your bills or to outweigh your expenses. So that's what finance is. That's the goal. So you need to manage money one way or the other. But the idea is at the end of the day, you want to make more money than you spend. And unfortunately, or maybe it's fortunately, again, back to personal stuff, but again, it applies to businesses, is immediately you are born, immediately a business is formed, it starts to require resources. And those resources cost money. So what I'm trying to say is that if you set up a business right now and you want to do anything with it, you don't make money first and then start to spend it. You actually have to spend money first, and then, or you're actually going to need some things, then you're going to spend money, then you have to go and find a way to earn income to be able to cover those expenses. So ultimately, what you want with finance, or what we do with finance in any level, at any level, whether it's a big operation or a human being, is to ensure that we make more money than we spend. So if we now say, if I want to call it the ultimate goal, so if this is the goal, the ultimate goal is to then make a lot more money than you spend. So sometimes you just manage money to the point where, okay, I'm managing myself and all of that. But ultimately, most of us want that goal where, as if we have a lot more money coming in than what's going out. So that's the ultimate goal of finance. So everything I've said so far is actually leading me to the next fundamental truth. And that fundamental truth, once you understand this, like you understand everything in finance, is that all business decisions are finance decisions. So if finance is the management of money and the business is set up for money, and you want to manage that money in such a way that it makes more of it, more than what you spend, then it just goes straight to reading that all business decisions are finance decisions. So it doesn't always seem that way at the beginning, but that is essentially what it is. So if a company decides to hire someone today, it is a finance decision. If they choose not to hire that person, it is also a finance decision. Who you are going to buy from, a vendor, it's a finance decision. if you're supposed to start a project or you delayed, it's a finance decision. And in fact, there are decisions and there are indecisions and there are actions and inactions. So you want to do something, it's going to cost you money. You don't do the thing, it's going to cost you somewhere else. So there's also the cost of indecision in some of these things. So, and again, finance is so broad that it takes accounting, it takes economics and all of those things into consideration. So when you think about your economics days, you would remember the scale of preference and opportunity cost and things like that. All of these things come to bear in when you are dealing with finance. But on the surface, it doesn't really seem like that. So if you look at a company, whether they choose to, say, for instance, have an office in Lekki or an office in Osogbo, that in itself is a finance decision, because directly there will be the cost of the rent or whatever it is to set up in those places. The cost of living are completely different in both areas. But then there's not the associated cost around even how do customers perceive you? How do people perceive you? So every single thing that a business does, whether they think about it or not, is a finance decision. So if you don't take anything away from this session, take away the fact that all business decisions are finance decisions. You can argue with me later in the way if you ask me what to ask me questions, but that's like a fundamental fact. I've seen accounting and financing all sorts of ramifications, and that's actually, when you look at what's really impacting how much we made, is pretty much people's actions and people's decisions, or inactions and decisions. So I've tied everything back to decisions. So again, if all of this is complex, please just apply it to a personal perspective. So whether when you wake up in the morning or, for instance, you decide that you want to work from home, you want to work hybrid. So if you had woken up and gone to the office, you would have actually incurred a transportation cost, like a commute, cost of transportation, the cost of the commute to work and things like that. So when you then decide, okay, you know what, I'm going to stay at home and work from home today, you then be like, well, I saved transport cost. But then you will not incur another cost of having to provide probably your own internet, your own power, or your own everything, your own space, that ordinarily, if you had gone to work, the company would have provided it for you. So all those decisions, where you choose to live, what you choose to eat, all of those things, if you look at your bank balance or look at your bank statement, all of those things are actually a result of your decisions. So bringing it back, the idea here is that decisions, as we are human beings, I read an article that says we make about 50,000 decisions a day. Most of it is involuntary, like we don't even know if we're making them, but we're actually making decisions up to about 50,000 a day and others. So, and what actually drives the decisions we make are the information, or is the information that we have to make the best decision. So decisions would be made regardless of whether you have good information or bad information or incomplete information. In fact, when I work with a lot of founders and business people, they're actually very good with taking decisions with having only 20% of the information. And that's like very bad news for us in accounting, because we are very, very meticulous. We want to know what is driving what. But there's some people actually very comfortable in the business world, and which is not a bad thing in itself, making decisions with half of the information or even less than half. But anyway, the point is, if all business decisions are finance decisions, and the decisions affect how much money we make, how much money we keep, then it then goes to say that we need to have quality information to actually make better decisions. So if you think about it, sometimes you want to buy a stock item, like shares, I know. most times it's the information you get that would make you like, okay, let me go for this stock and not this other one. Or if you want to buy something and then the information you have is like, this thing costs 50,000 naira, and then you buy it. And then afterwards you find out that, oh, there's somewhere that you could have gotten it for 20,000. It's the information that you had that actually drove the decision on where you bought it. So sometimes that's why companies have things where they do artificial scarcity and things like that, just to mess with the information you have so that you can take certain decisions. So ultimately, information is very simple. It follows a very simple stuff: garbage in, garbage out. So when information is not available, when it's late, when it's scattered, and all of those things, the kind of decisions you will make will be based on that. So you would see that some companies that are struggling, or even some human beings that are struggling, it's just because they don't have good information system to make the best decisions. They are making decisions, they are making money, they're making decisions that make them money, but they're also making decisions that's costing them a lot of money. And some people, their decisions are not even letting them make as much money as possible. So I know it's getting a bit psychological, but that's literally how it works. So at the same time, if you have good quality information, then you would actually make better decisions. So none of it is a guarantee. Some people make good decisions with bad information, but I would say that's exception to the rule. And some people, you give them all the information in the world and they'll still make a terrible decision. So that also happens. But the point here is, in finance, whatever the decision is, whatever the action is, that is what drives finance. So that's literally the basics of finance. So now that we then understand all of these actions, decisions, bases, all of these things, is then to then see, okay, if you are looking at a business right now, you would actually realize that, and I'm going to say more than 90%, but let's just say at least 90% of what we call finance activities actually happen outside of your finance department. So a lot of people see finance department and think they just do accounting. But accounting is not finance, it's different. Accounting is like literally recording it. But people would manage money regardless of whether they have an accountant or not. In fact, I know many businesses that have not seen an accountant in years and they are making money, I know. So you don't really need an accounting team to do finance. And that's really because what we're calling finance activities, how a company makes money, how a company spends money, is totally outside of having a finance department. A lot of the time, what that finance department is doing is just processing what other people have actually done or thought of. So if you're a non-finance person today on this call, you have to actually understand that it is your actions or your inactions, your decisions or your indecisions that actually create what we call finance. Because at the end of the day, what we are spending, what we are making, what we are spending to make what we are getting, all of these things are coming from finance. So if a company says they made 20 million in revenue, the finance department literally has a very small impact in that. So the bigger impact comes from the management, who they hire, the people they hire. Did they do what they're supposed to do at the right time? Did they take risks? Did they take good decisions? Did they actually act when they're supposed to act, and all of things? So all of those things are the actual things that cause us to have what finance is. So the decisions those people take actually also lead to information that the business has, then leads to other decisions that other people take. So again, maybe in some or in most areas, you find that the management actually, the weight of the decision of management is actually very heavy. But then you also have some companies that have actually lost sales. They've lost revenue because they hired the wrong customer service person. So the customer service person, somebody called in, the customer service person was rude and and in that space, like, I'm just a small receptionist / customer service person, but meanwhile, it might cost the company a whole lot of money. So all those decisions and those actions in those spaces actually impact what we call finance more than anything else. especially when you realize that all business decisions are finance decisions. So we now want to come to the concept of what we call finance, or what we see as finance. Ultimately, all of these things are results. In fact, we call them financial results. So when you say, yeah, people talk about the three income statement, or the three statements, which is income, balance sheet, cash flow. Those things are results of actions. Those things are results of inactions. Those things are results of decisions that are taken. So it's just a way of where we kind of like structure them and say, okay, this is what it means. So we have three big statements. One is the income statement, and that shows us how profitable we are. So if you get into any business at all, profit or non-profit, you are going to be involved in certain activities that will require somebody else to give you money, a third party to give you money. So you can't make money on your own. You can't make money from yourself. If you are going to make money, somebody has to give you money. And because of how everything works, remember, it's making money, spending money. Some of that money that people are giving you, you have to spend it on something else. In fact, you cannot make money without spending money. So that's where we have something called cost of sales and cost of sales. So you sell, and then you have a cost of selling. So if you sell 10 shoes, for instance, you actually have to buy the 10 shoes first before you can sell it, except you steal it or something. But even that is something. So if you are selling knowledge, you actually have to acquire the knowledge first. So at the end of the day, you are going to subtract how much you spent from how much you got. Usually that's what our profitability is. So an income statement, and all these things are called statement because we're actually stating it as a fact that this is how much I made, this is how much I have. So in your income statement, you would see profitability. So under there, you see things like revenue, or sometimes we call it sales. So that means how much did we sell? Again, your finance team is not really involved in the selling. At worst, they are probably just raising invoices, but they are not involved in the selling per se. But we want them to record what was sold. But the selling happens outside of them. The margin, that's your revenue versus the cost of that revenue, which is if you are selling microphones, you have to buy the microphones first. If you are like MTN and you're selling airtime, you actually need to buy the infrastructure and pay people to be able to provide that. So you have to subtract that to get your margin. So a lot of people need to know their margins and know, am I making 5 naira per sale? Am I making 10 naira per sale? Am I making 3 naira per sale? Because again, all of this is information. Because if I told you right now that, oh, I'm going to sell this thing, so I'm going to give you 1 million naira, or if I'm going to sell something to you for, you're going to sell something to me for 1 million, I'm going to give you 1 million naira. And another one, and somebody's going to give you 300,000 naira. Which one would you choose? Everybody would pretty much choose the 1 million naira one. But if I then told you that, oh, the cost of this 1 million naira item is 990,000. Well, meanwhile, the cost of this 300,000 naira item is 50,000. You then quickly realize that that changes what you think, because the one that you sell for 1 million, you're going to make only 10,000 naira from it. But the one that you are going to sell for 300,000, you're going to make 250,000 from it. Now, that one has a higher revenue, but lower profits. So that's how those things flip. Again, the information. So once you have that information, be like, okay, this 300 one is more valuable because I make more profit from it. So that's what your income statement tells you. So your balance sheet is what we call your finance position. It has many things inside. I won't go into it most deeply, but mostly what you find here is what we call your net assets. And for individuals, it's called your net worth. So it's pretty much what you own minus what you owe. So the business owns assets, like they can decide. So even as an individual, you can go into your apartment right now, you see that you have a television, you have a fridge, you have this, those are your assets. Then if you have any liabilities, then you then find out, okay, that I'm owing somebody that. So today, if everything ends today and then I say, pay me, you must pay me. and all of that. And they say, okay, let's go and sell all your assets. Let's go and sell your fridge, your TV. At the end of the day, what's the net position of that? So finance information there is required to be able to grow your net asset or your net worth. So when you're making money from your revenue, you can only make money from revenue. Every other thing is artificial. Somebody is paying you money. So as an individual, somebody is paying you a salary, you earn revenue. So you can actually have a whole lot of revenue and then you're spending the money on expenses. Or you could have a whole lot of revenue and decide, oh, okay, based on this, I think I need to buy more shares in this company, or I need to buy land, I need to buy this. So you're not taking that money and using it to buy assets. So with your information system, you can then see like, oh, if I put more money in this thing, yeah, if I invest in this thing will give me 5 times more returns in the next 3 years, in the next 4 years. Or you have the liabilities, oh, so I'm owing this person. Let me pay this person now so that I will have more net assets. So you want to increase your net worth, you want to increase your net assets. That's essentially what we do with the balance sheet. And for the final statement is called the cash flow. Technically, accounting has some principles that ensure that we capture a whole lot of things that are not cash related. But despite that, cash is king. So what ties a finance person in and a non-finance person, or an accountant, a non-accountant, is cash. Everybody speaks cash. Give me money. I know. So we have a statement in accounting that shows that, or in finance that shows that. How much did we get from operations? How much did we get from growing? How much did we get from investing? So many companies, like I'll give you an example of startups. Many companies have a situation where they're going through Series A, Series B, Series C funding. And most of what is happening there is that they are actually they've gotten money from somebody, but they've not made a lot of money from revenue. They've not sold enough. But they got to a certain point where they now say, okay, we need somebody else to come and invest in the company and pay off the first people that invested. So it kind of like looks like a Ponzi scheme. But again, all of this is just information and decision. So the final point here is, the final main point here as I get 30 minutes, is that once you know how finance affects the results that would happen at the end, what you can do better is to plan. So what you can do very well is to plan better. So that's where budgeting and forecasting now comes in. So in your head or in your stuff, you actually have a sense of, okay, if I actually take this money that I'm earning now and use it to go and do a master's degree, I'm going to be able to position myself to earn a higher salary. I know. So that's all that decision, and all that is planning. So in business, I'm using personal examples so that everybody can get it. But in business, it's just more of, you know what, if I buy or if I hire 10 more people or 10 more sales staff, my revenue will increase by 100%. I know. That's planning. So yes, you want your revenue to increase by hiring 10 more people, but by just bringing those 10 people in means automatically salaries, welfare, laptops, utilities, if you're in an office, will increase. All of those things. You have to plan for it. So yes, everybody knows if you get more salespeople, of course, you get more revenue. But how would you even manage getting? It's not as if they will come in today and tomorrow the revenue will just increase like that, things like that. But we want to expand. So once you are doing any sort of planning, you have to look at the financial planning aspect. So you have to look at the results and say, okay, this is potentially how it's going to affect my income statement. Potentially, it's going to affect my balance sheet. Potentially, it's going to affect my cash flow. But then it's very okay for you not really go deep into the finance aspect, but at least consider it, because anything you're planning for the business would actually have a financial implication, because all business decisions are finance decisions. So again, if you're a non-finance person, if you're a finance person, you probably get it, or maybe you're looking at it from a different angle. But if you're a non-finance person, first understand that you have more power, depending on your role anyway, but you have more power on how your company makes money, especially as you move to managerial roles. A lot of the decisions you take on behalf of the company or even for the company have a very big influence on what we call finance in that company. So your good information is vital. You need to develop good information systems that make you take the best decisions. And as much as you want to make the best decisions, you want to act accordingly. So decision is one thing, then acting is another. So when you are considering your planning, your planning helps the business win. They actually help the business win when you really think about your role in all of this. So I'll just go like 30 seconds beyond this time because it's about getting to 30 minutes to just give you one example that I had in one of my businesses that I worked for. So we had a situation where we were producing stuff for a customer, and because it was a manufacturing concern, and then so we have the floor plan, or we have the plan for how everything should do. So they're supposed to make 10 tables or 10 items, and we've already planned how everything should work. They're supposed to do it in 8 hours. So, which is like 9 to 5. So when it was 5 o'clock, they had actually done only 6 tables. And the thing needed to go to the customer, as he couldn't really wait. And everything is planned, everything working very well. 10 hours was more than enough for them to finish the tables, but they had only finished 6 at 5 o'clock. So anything after 5 o'clock is overtime. People say they want to go home. Now the guys come to finance and say, we want overtime, that we didn't finish the work, but we must finish it. If we don't finish, the client will be upset. So in their space there, they're just thinking, we need to stay longer to finish this work, which kind of makes sense. We have to finish it. But what they were not considering was that for every hour they were going to stay after that 5 o'clock, we're actually going to pay overtime. That's cash out, 1. 2, we are going to run diesel. We're going to run diesel because there's no even light. Even if there's light, we are going to run diesel for that time that we should have actually shut down and closed for the day. Operation was supposed to have closed. So we paid more for the overtime itself. We paid more for the diesel. Now the machines themselves were now working. So there's something we call depreciation from use. The machines started work. So just that in their head, it was just like, we have to do overtime anyway because we've not finished the work. But in the finance decision or the financial implications of the things behind it was more diesel, more overtime payment, which we shouldn't have paid, and more maintenance for the machinery. And all they could see, and I really don't blame them, but it's how people say things. All they could see was like, we just need to get the job done. So that's how, and I have like thousands of examples like that. Because by the time we do everything, the customer is not going to pay us any extra money for overtime. It's not their business. We've already agreed the money with the customer. We've already agreed the cost. But now you see this additional cost we are now taking, we are now spending just because people didn't finish their work on time. Is how you see how those things affect finance and financing activities. So thank you very much for listening to me for the past 30 minutes. I hope you got 1 or 2 things, and I'll be happy to take your questions. But hopefully you really understand how finance works and how you start to be able to use it to affect your personal circumstance, if you want to, and your businesses that you work for or own. Thank you very much.
Thank you so much, Ajibola. Thank you for sharing with us. Thank you. Okay. We've all heard about finance, and I'm sure we've learned something new. Or we've had gotten answers to some of our questions. So if you still have questions, please drop them in the comment section. I'll be looking into the comment section and reading out your question. But if you would like to use the mic as well, just raise your hand and I could tell you to unmute. So while we wait for questions, I'd say have learned something new. I mean, first thing first, if money is involved, it's already finance. If money is involved, it's already finance. And I think I like where you ended or where we ended the session. And it was talking about, financial decisions and then managerial role. And I think I do have a question. So if someone is, as a professional, you're looking to getting into the managerial role or position someday, and then you notice that you're getting close to that position, what are certain things in finance that one should pay attention to? Whether in a mindset shift, whether in technical skills, with basic knowledge, or technical skills, or like I said earlier, mindset shift. What are those things that one should pay attention to, because you know that you'll be actively involved in finance in the in the organization? Yeah, that's my question.
Yeah, so thank you. So I think it depends, but one of the first things is this basic knowledge, like having that grounded knowledge in understanding that once you move into a managerial role, you now have a bigger role to play in how much your company makes or how much your company spends. So depending on the role, some roles are actually what we call cost centers. So they don't really earn the business money. They are supposed to they spend, but you need to spend to make money. And there are some roles that they are actually client facing, they bring money in. So really understanding that, okay, going into those managerial roles right now, you actually have a bigger impact on the bottom line. But ultimately, and I think it should start early, even before managerial roles, is to really know the numbers. So no, and not the numbers in terms of the like don't go and learn accounting, but it's not really necessary. You can still get it. It's really understanding the numbers that drive the accounting. So again, the example was from that last story I gave. So if you have 8 hours to produce 10 tables, and then you take that same 8 hours to produce only 5 tables, to understand what the implication is, like there's inefficiency there. So one of the things you want to do as a manager is like find the ways around, okay, how do we optimize this thing? So if I'm supposed to do 10 tables in 8 hours, as in what needs to be in place to ensure that this happens? So how do I know when people are slacking? Is it the machines that are bad? Do we need better machines and things like that? So really knowing the numbers, knowing the operational numbers behind the financial numbers is a very, very great place to start.
So operational numbers behind the financial numbers. Okay. Thank you. Yes. So, and I also feel like that thing that you said about decisions, indecisions, actions, and inactions all affect, financial decisions. They're all business financial decisions. Yes, thank you. I saw a question in the chat box, and I'd like us to take that now. Oh, okay. So someone says, as an emerging entrepreneur, I'm curious about how much profit margin should influence the choice of a business to start. For example, business A costs 20,000 naira to run and returns 20,000 naira profit, while business B costs 100,000 naira and returns 50,000 naira profit. Even though business A has a higher profit margin percentage, business B brings in more absolute profits. In situations like this, should profit margin be the key deciding factor, or what would you advise entrepreneurs to consider when choosing which business to pursue?
So that's it's a brilliant question. But the answer is in a lot of things. So profit margin is just one one factor in a lot of factors. So so anybody that's about to start a business right now, and if you go through the proper channels, because a lot of people get into business, they go through the proper channels. One of the first things they ask you is a business plan. And that business plan contains so many things that's bigger than just the margin. So I wouldn't say that the margin in itself is a deal breaker. So there are very low margin businesses, but they are low margin, high volume. So for instance, let me keep it very simple. People that sell airtime, people that buy, so we don't buy airtime directly from, say, MTN and things like the MTN sells to some people and they resell before it gets to where we are. So the margins on those things are literally naira. I want to even say kobo on it. So in fact, it's one of the reasons why we can buy 100 naira airtime at 100 naira. I don't know if anybody is old enough to remember a time that used to buy 100 naira airtime at 120 naira. And that's because the cost of why the person bought it was already at 100 naira. They couldn't sell it at 100 naira. So my point there is that those things actually have low margins, but high volumes. So once you are doing your business and you know that, okay, you know what, I'm going to get enough volumes, like literally MTN has millions of seconds per day, people are calling. They have enough high volumes to cover the entire cost of the business. That's fine. And there are some people that do high volume, high margin, but they don't do as much volumes. Those ones to come there as well. And ultimately, what you want is high margin, high volume, but a lot of nuances go into all of those things. So I would say the main thing that's required is just ensuring that by the time you get to your margin in absolute numbers, so whatever the revenue minus the cost is, whatever margin you have there, does it cover your expenses? So if it covers the expenses and you're comfortable, then that's fine. But generally, every business has its own nuances.
All right, thank you. I hope you got your answer. Hope he answered you correctly, and I hope you're satisfied. So I can see someone hand raised. So we'll take. Oh, okay. Thank you, Peter. We will take David Olalua. Please, you can unmute and speak. Hi, David. I can see that you're on mute, but we can't hear you.
Can you hear me now?
Yes, we can.
Oh, good evening, everyone. Good evening, Ajibola. So I have two questions. Now, well, I might be a little selfish, but yeah, so when companies, we all buy shares and I'm looking to make better financial decisions. So when companies release their financial statements for the year, and I know that they release I think their comprehensive income and I think cash flow statements. So which of these particular statements should we pay more attention to as, should I say, investors? We are buying shares. So which of these financial statements should we pay attention to? And as an HR person, as an HR personnel, what are those? You talked about efficiency. So how do I help my company? What are those things I need to look out for as regards helping my company save costs? Did you get my two questions?
Yeah, yes, I did. Thank you. So the first one, so all of these things have nuances. So you need to be able to properly read financial statements. So there are many things you have to consider in part. So that would kind of like make your decision for you. So because for instance, a company that is profitable might actually not have cash, like literally not have cash because of how accounting works. So if you say, okay, I want to look at profits, then then you can easily be misled. You have to look at the profit in conjunction with the cash flow. And there are also other companies too that have a lot of cash, but they don't have revenue, they don't have activities. So you would see a lot of companies that actually are getting funding from investors or from loans that need to be repaid. So you look like they are very liquid, they have a lot of money, but the money is not from operations. So you can't just look at cash in itself. I thought this company has a lot of money, let me put my money in. And different companies do different things with their assets or with their balance sheets. So my point there is you can't just look at one thing. There are always like a combination of factors involved. So, but if you have a public company, this is what you really do. So first off is you actually have people that we call analysts. That's their job. In fact, there's this certification called CFA, Certified Financial Analyst. There are people that take that thing very much more seriously and even regular accountants. So what they actually do is they analyze the results of the company. They analyze the results this year, they analyze the trends, they analyze the industry, they analyze all of those things like for you. It's not a small job. It's not something that what I would say a layman should just like look at the financial statement and say, okay, let me go and put my money in here. You actually have to look at a lot of factors, and there are these guys that actually do this, and they are very well paid to actually do this. They look at all of those things. Even in financial statements right now, especially for public companies, there's a place where you must have the chairman's statement and the director's statement. And they will not just even tell you the numbers, they will tell you their plans, they will tell you what happened and things like that. So what I'm saying here is going back to the initial point that I made. There's a lot of information required to actually take that decision, and just need to ensure that you actually have all of that information properly distilled for you so that you can then go ahead and take the decision. So long story short, I won't advise anybody to take the financial statement only and look at it and say, okay, yeah, this is the basis for the financial decision without considering what your regular analyst would. And then the second one, so I mean, at the end of the day, again, there's money coming in, we want to maximize that. And then there's money going out, we want to minimize that. So every operational department or every department has their key roles in those two things. Either help the company make more money or help the company reduce money. So if you're HR, I would say look at your KPIs. What are your KPIs? Trust me, if you look at your KPIs very well, you will see that they actually relate to how a company would save money. So one of the first things, one of the obvious things is head count. So you're looking at the head count, that's your salary. How can we manage that? How can we manage it? Is there, because sometimes you might want to hire somebody and the person's salary is like 1 million naira. You're like, that's too expensive. Then you hire somebody, the same job, same whatever, and you hire the person for 300,000 naira. And then you find out that the person that is doing 300,000 naira does not even know what they're doing. And they're actually now messing everything up, and they're actually costing the company a whole lot of money to fix. So it might look like, oh, we are saving money from not hiring the guy that actually knows what they are doing, to somebody that like, yeah, let's see if they can figure it, because we're saving the company money. Meanwhile, the cost of not having that expertise or experience is actually costing the company a whole lot of money. So that's one angle to look at it. But ultimately, you look at things like efficiency, effectiveness, all of those things. You would see that if people come to work when they're supposed to come to work, they do what they're supposed to do, they meet, you will see that all of those things actually have a very direct impact, or maybe indirect, but mostly direct impact on how much the company is making or how much the company is spending. And ultimately, that's the best you can do.
All right, thank you so much, Ajibola. David, I hope your question has been answered. So we're getting close to the end of this session, and I just want to let you know that the feedback form is in the comment section. If you do not fill the feedback form, you won't be able to get the certificate. So when you fill the feedback form, in some seconds, you get an email or a link to get your certificate. So it's very important that you fill the feedback form. And when you do get your certificate, you can post on social media and tag Crosstie Solutions. Also in the chat box, there is a knowledge of, which is our community, where you get to see our next coming webinar. And also we also drop nuggets and share learnings on the group. Yes. Also, there is a resource vault in the chat box as well. If you have enjoyed this session and you like to learn more about finance or just read something from us, you could go through our resource vault on several topics. We have short books there, very interactive, very enjoyable, appealing to the eye. You would find them there and then you're able to read. Okay. I would like to know if anybody had any questions before we close today's session. Please, if you have questions, just drop in the chat box. While we're waiting for your questions, I'd like to say thank you to Mr. Ajibola. And if you have enjoyed today's session, if you've learned something, we've learned from, money, finance. What's finance? Personal finance, corporate finance, accounting as the language of business. Thank you, Mohammed. Yes, let's show some claps for our facilitator today. And then we've also learned that, the ultimate goal of any business is to make more money than you spend, right? We've also learned that all business, decisions, indecisions, actions, and inactions all feed into financial decisions. And then we also got to learn about income statements, cash flow, balance sheets, and all of that. It was such an insightful session. Thank you so much for today. We're really grateful. Thank you, Mama. Thank you, Peter Bebo. Thank you for everyone that joined. I'm checking the chat box again to see if we have any question. But I think so. Before today, when we posted this webinar, someone asked a question. In a layman explanation, what would you say is the difference between cash flow and profits? So I'd like you to please help us answer the question. The person is on this live. Yeah, I can see the person. So please, I would like you to do justice to that before we round up.
So cash flow, profit is your what you've sold minus your expenses. So that's very simple. There. And not everything you sell is in cash. Or it's possible that you can sell things and not receive the cash until later. So in finance or in accounting, we actually capture everything we sold, whether we receive the money or not. Same thing with the expenses. And even the expenses is much more nuanced. There are some expenses that don't even involve cash at all. So but all those things are accounting terms, but they actually go to show how profitable a business is. And that profit is not all cash. So there are very few businesses that have that situation where all their sales and all their expenses in cash. So that means that profits cannot be cash, and it's possible to be profitable and not even have cash. And it's so cash flow, on the other hand, is just pretty much is the timing. It's like the timing of how money is coming in and how money is going out, in and out of the business. So by definition or by classification, you have money from operations. So that means from what we sold, like we said earlier. But then you also have money from financing. So a lot of businesses get money from either the owner investing in the business or taking a loan. So that's financing. Then you also have some money coming from investing. So that means maybe you took some of your money before, used it to buy shares, or you bought a property, and from there you're making some money from it. Those things are what we call investing. So your cash flow is much more bigger than just what's been sold that gives you profit. So essentially, they need to tie together. You want to have high profit, high cash. So all of those things that we are talking about in decision making is, okay, how do we make the two of them balance? Thank you.
Thank you. Thank you. I hope this person got their answer, and that would bring us to the end of this session.
Ademide, please, I'd like to ask a question. I couldn't raise my hand earlier. Good evening, Ajibola, and thank you so much for joining us on this session here today.
Yeah, good evening. Thank you.
Yeah. So I mean, my HR was asking a question earlier. You mentioned cost center, right? Which I think would be I'm sure she's laughing right there.
Yeah.
Because you had mentioned about cost center. And I think it will be a learning for every one of us on this call. So a lot of cost centers within an organization, from HR to L&D to legal to IT to admin, finance even itself, we are mostly all cost centers, right? A lot of cost centers in organizations, when they are making presentations, especially now, this is budget time. So I'm very sure that our audience will be looking forward to when they are making their budget presentation. I see a lot of people get quite very emotional in their presentations. Oh, say for example, I want to do a training. Oh, I want to bring in one top trainer and all of those things. And I've seen HR being sent out of the room during budget review or budget defense. Why? Because they get quite very emotional in their defense and they don't get strategy, because the decision maker, I mean, you have said it here, management only understand finance. It's about the money we are making. How do you think, or what do you think should be the language of cost centers whenever they are making presentation, even though their intentions are very good? But what do you think is that thing they can add to it to convince that man who is already thinking about return on investment? If I'm going to invest 10 million, 20 million in this training program, what am I going to get in return? What do you think cost centers within an organization should have in their conversation, in their defense, in their budget defense, that can convince the decision makers to say, oh, we are going to approve this going forward for you because of the way you had made that presentation? I think our audience would like you to probably address that as well. Thank you very much.
Yeah, thank you very much. So the answer, you made the answer while you were getting to the question, and the simple answer is ROI. What's the return? So cost centers should not really see themselves as costs, as to where money goes to fritter away. It has to come back in, okay, what is the benefits of the business? So we call it ROI. What's the return on this? So we are spending this. What is the return to the business? So in other areas, we also do call it cost benefit analysis. So whoever is presenting things that needs to really understand that spending money, so we use the word emotional. Actually, spending money is emotional. It's kind of somehow you don't want to spend it for everybody, except somebody is telling you that, okay, if you spend this money, this is what's going to come out of it. So we need people to really go beyond the fact that they just want to do things and really tie it back to this is the benefit the business is going to get. So again, and it's always either two things, or I'll say 2.5 things. Is either whatever you are doing is going to make the company money, or is going to reduce what the company is spending, I mean, in the long run. So one big cost can actually reduce small other costs later on. You need to be able to show that clearly, or a combination of both. So that's language of really quantifying, not just even saying it, being able to quantify the benefits of this cost of these areas is very, very critical for cost centers.
Did you get that?
100%.
All right.
Very good.
Thank you so much, and thank you for asking that question. I mean, I got to learn something, and I'm sure that audience also learned that. Thank you. Also got that rather. It's past 6 and we have to go now. It's been an exciting one and a very educative, if you ask me. So once again, I'd like to just remind us that the feedback form is in the chat box, and then we also have a link to our knowledge of. Please kindly join and fill the feedback form so that you can get your certificate. Yes. Thank you so much, everyone, for joining. I'll see you in our next webinar in December. Have a lovely evening. Thank you once again, Ajibola, for joining, for taking us, for explaining this to us. We really do appreciate you.